Are you leaving money on the table with your business taxes? For business owners making under $1 million, every dollar counts. Today, we're diving into smart tax strategies that could save you thousands, and some of them might surprise you.
In a world where chaos seems to reign supreme, where uncertainty lurks around every corner, and financial markets are now more unpredictable than ever, there's one place you can turn to find clarity and control. Welcome to the Wealth Wisdom Financial Podcast.
Hey, I'm Brandon.
And I'm Amanda.
Join us as we dive deep in the world of personal and business finance
to assist you in navigating through the chaos and building the financial future you deserve.
We believe when conventional financial thinking doesn't get you where you want to go,
you need wealth wisdom.
So if you're ready to take control of your financial destiny,
tune in to the Wealth Wisdom Financial Podcast.
Because in a chaotic world, your money shouldn't be.
Subscribe now and never miss an episode.
Welcome back. Tax season is upon us. And if you're running a business making under $1 million, you're in the sweet spot where smart tax planning can make a huge difference to your bottom line.
So first, some good news. Congratulations. You've already done one of the best things that you can do to reduce your tax obligation overall. You started or bought a business. Way to go. Good job.
Right.
The Internal Revenue Code has numerous tax advantages built in specifically for small businesses. So you're already set up to take advantage of those.
Now for the bad news. Most owners either don't know about those tax advantages or are afraid to use them. Perhaps rightly so, because misuse of those tax advantages can land you on the wrong side of the Internal Revenue Service. And no one wants that. I've talked to many clients who have been on the wrong side, and it's not a fun place to be.
Yeah, and actually be sure you subscribe to this podcast, because later this month, we're going to talk about how to stay on the right side of the IRS and not get on the wrong side and things to avoid and stuff. But for today, we want to talk about, even though the Internal Revenue Code is very long, very complex, there's never a better time than right now to get to know a few parts that likely apply to you and use them to your advantage the way they were meant to be used. So let's get into it.
Today, we're breaking down 3 key strategies that work specifically for businesses with under $1 million in gross revenue. And yes, we're talking about your total sales before expenses, not your take-home pay. If you're making that, that's awesome too. But we are focusing on businesses that are making just shy under $1 million.
Yep. So speaking of which, I see too many business owners paying themselves salaries thinking it saves on taxes. Here's the truth. Showing healthy profits can actually help you qualify for loans, attract investors, sell your business down the road. Smart tax planning isn't about zeroing out your profits. It's about optimizing them.
Yeah, I see this all the time where they're like, yeah, but I made a lot, but I just don't show a lot. And then they try and get a loan and they can't because, all that fun. I mean, it happened for us, right? When we were moving into this business, we could not buy a house because we didn't show income yet because the business was so new. And so you want to show income.
And then one quick reminder, we're not tax professionals. This episode will empower you with knowledge and ideas to bring to your tax professionals. And we're not giving any kind of individual advice here either.
Yeah, we have learned a lot and we're just passing on the knowledge and knowing as a financial person how the tax code can benefit or help you on the tax side as well.
Okay, ready to get into the 3 strategies?
Yeah, let's go.
Yeah, there are more, but these are our top 3. So strategy number 1 is strategic timing of income and expenses. Understanding when to accelerate or delay income and expenses between tax years. Now, we're in March when this episode's coming out. This is often a topic for December or January, or probably actually October to prepare for later. But you might be in a fiscal year, right? So whatever it means between tax years for you, you want to think about this. You might have control over your cash flow and can delay or rush your accounts receivable, get people to pay you earlier or delay them paying you, or you can build into your contracts payments that fit into your tax strategy. If you're negotiating a contract in March that gets paid over time, you can negotiate if you get a big payment in December to get it all into the tax year, or if you delay that into January. In lower income years, you want to accelerate payments to you, delay payments going out, set reminders in your account receivable in December to make sure and you're getting that income in those lower income years and not delaying it into the higher ones. Maybe even give discounts if people will pay you by December 31st. Maybe you negotiate to defer some expenses until January instead of paying them in December. And then on the flip side, in higher income years, you delay payments to you and consider moving up expenses into the current tax year.
Yep.
So you might have fewer account receivable reminders prior to January 1st, or change the due dates on your invoices to be January 2nd instead of by December 31st. That often delays people. They don't pay until it's actually due.
Yep.
See what kind of discounts you can get by paying in advance in December rather than throughout the next year. There's a lot of moving things here. Remember, though, under the cash accounting method, if a payment is available to you in one tax year, you aren't supposed to defer it to the next. So if you negotiate terms and you get people to pay you later, great. But if the check is in your mailbox and you leave it uncashed, that's not a delay of income. If you were able to cash it that year and put it in your bank account that year, it needs to be counted that year. Delaying cashing that check to put in your bank account doesn't delay the income.
Yep. In the December rush to add expenses and reduce a tax burden puts too many businesses in jeopardy in the early part of the next year, right? I see this all the time again. It's better to have a grasp on profit and tax strategy throughout the year so you can make good decisions during the business's natural ups and downs, which probably don't correlate with the calendar year and all the craziness at the end of the year with December and all the fun things in right at the end. I see it like so many. I mean, you know this, you see it too, like all the, hey, buy now, do this, and we make big wrong decisions. Now, again, strategic decisions is a different story.
Yeah, we actually did a couple of podcast episodes in December this past year were about how people rush to make decisions in December and then make bad decisions because they're rushed. So I'm going to give you today 2 proactive ways that you could do March, April, May, like throughout the year, so that you're not so rushed in December. So the first one is setting up regular income and expense tracking so you don't miss deductions and you're making more intentional choices. When you're negotiating that contract in July, can you tell if you want the terms to be paid this year or next year or a mix of both? If you can't, then you need to have a better tracking system.
Yeah.
And then the other way to be proactive is be sure that you're working with a tax professional where you can schedule a tax planning review with that professional in October each year to see how things are looking for the year. And that gives you more time, October, November, and December, to make adjustments without feeling rushed.
Yeah. I mean, we've done this for many years and our income has fluctuated, right? So it's been helpful to have that conversation. Again, we know a lot of this stuff. Since we've, are in the financial world, but talking to somebody who is licensed in that area is really helpful for us too.
Yeah.
Because things change,
Yep.
right? I mean, the tax code is bigger than the Bible. So
you had to bring that up.
Yeah, it is true.
So that's strategy number 1. Be creative with when you receive income and have expenses, especially if you're in the cash accounting method instead of the accrual. Now let's go into strategy number 2, which is about maximizing your qualified business income deduction, what some people call the QBI deduction or the QBID. I've heard it referred to both ways.
Yep.
This is a 20% deduction that works for businesses under $1 million. It works for pass-through businesses like sole proprietors, partnerships, S corporations, and it allows you to deduct up to 20% of your qualified business income. Now, what is qualified business income? This means your share of the business's profits. So you can't deduct your wages that you pay yourself. You can't deduct your investment income or any kind of capital gains, but of the business's profits, those distributions maybe that you pay to yourself, you get a 20% income deduction there, qualified business income deduction. Now, there are some business activities that qualify and some that don't. Most trades and businesses qualify, but there's some exceptions. If you're in a service business, that could be you, healthcare, law, consulting, you can face some limitations there. Rental properties may qualify if you meet certain requirements. Having good documentation of your business activities is crucial here. So you want to make sure you and your tax pro are on the same page about what your business activity is in honesty and if it qualifies or not.
Yep.
And then you can think of, you got your activities set, then you want to think about your structure of your business. Consider how you pay yourself, salary versus distribution. If you're an S Corp, find that right ratio there. Look into the timing of your purchases and income, like we talked about in strategy 1. This is a good time to point out that the QBI deduction is set to go away at the end of 2025. And so next year, 2026, you may or may not have this deduction anymore. So this could be your last chance to use it. It all depends on what Congress does this year. So for 2025, think whether your business structure is optimal for the deduction and if you need to do any restructuring and if it makes sense for that, if the cost to restructure are worth the savings that you might get.
Now, we might have said a whole lot of foreign language to you. You're like, wait, what did she just say? This is why you talk to a tax professional or, again, somebody who's knowledgeable in this kind of stuff, right?
Yeah, but here's the things that are in your power. Some common mistakes to avoid so that if you get this deduction, you can make sure you get the maximum deduction that you need. The first mistake is not keeping clear records of business versus personal expenses. Yep. Make sure those are separate, right?
They should be separate.
And
again, let's
say
that your business records and personal expenses should be separate.
Yeah. And then make sure your business activities are classified the right way. Misclassifying your business activities is a common mistake. Third mistake, not considering how other deductions affect your QBI. If you're have a bunch of expenses this year and then the QBI goes away next year, you might miss out on some of that 20% deduction that you can get. And then finally, another mistake is forgetting to factor in the deduction when making your quarterly tax payments. Do not pay the IRS in advance. It's an interest-free loan. And this is coming out in March. You might be making your first quarterly tax estimate very soon. You might want to have this kind of conversation with your tax pro before you even send that in.
Yeah, I think a lot of times people don't realize that. Again, say that again.
So if you overpay and you're getting a refund later, they don't give you any interest on that money, right? So you want to pay what you need to pay to avoid penalties and fines and that kind of thing. But if you overpay, they're not going to give you any kind of benefit.
Yeah, and I hear this again all the time where they're like, ooh, I love it. I love getting this refund. And I'm like, again, maybe it's a good thing, maybe not.
Yeah, I hear that less from business owners, but yeah, still some business owners.
Yep.
Okay, so make sure you're using that QBID deduction. And then strategy number 3 is building a tax-diversified retirement strategy. This is where we move from talking about taxation year by year to talking about taxation over your lifetime. A lot of tax pros like to look really good and save you a lot of money this year without talking about what the implications are for that 20, 30, 40 years from now.
I mean, because again, that's how they make money is sales of look what I did for you now. Mm-hmm. But really, we want to look as a holistic approach of you now and you in the future.
Yeah. So when you're doing savings, whether it's for retirement or contingency capital or the what ifs, there's 3 different kind of tax buckets. There's the tax to later, like a traditional SEP IRA or a solo 401k that you get immediate tax benefits. That's usually the go-to when you're like, I owe what in taxes? Oh, let's start you a retirement account and move money there and you'll reduce your tax burden.
Yeah, they do it all the time. Again.
Yeah, just remember it's taxed later.
Yeah,
okay.
Still going to be taxed.
Yep. The taxed now, these are Roth and Roth-like options for tax-free growth. Cash value life insurance qualifies as that Roth-like kind of option.
Better than a Roth, I think.
That's your opinion. And then taxed never. These are things like health savings accounts that if you have large health expenses now or in the future, you can get a tax deduction now. And then as long as they're used for qualifying expenses, you never pay taxes when you use it for those purposes too. You want to just be careful. You don't put too much there and end up with this big pile of money you can't use for health and have to use it for something else. And then you get a 25% penalty. Kind of ridiculous. So now that you know those buckets, which you might have already known, but refresher, you want to think about how to balance these options based on your current tax bracket. Like we said, most tax pros are going to focus on saving you taxes this year and put as much as possible into that tax later bucket. But be sure you have an honest conversation about your beliefs about the future of taxes. No one has a crystal ball, no one really knows, but your opinion matters, right? And you want to feel good about the decisions you're making. So make a plan to reduce taxes over your lifetime and for your heirs, your beneficiaries, rather than being short-sightedly focused 1 year at a time. So let's talk about why having multiple tax treatments gives you more flexibility later on in life, in quote unquote retirement or financial freedom. Most people believe their income in retirement is going to be lower, but considering the following, for you, our small business owner, the tax deductions you might lose, all those business expenses that you currently deduct, or the children who are your favorite tax deductions, you might not have those in 30 years, particularly, right? Like you might have to pay your own cell phone bill, and that's a personal expense at that point, right? All those kind of things.
Well, and then also, again, if we're in retirement, as we are aging, one of us, if we're married, is going to maybe retire to heaven, and then that increases taxes too, because you're now single.
Yeah, single tax brackets are way higher than married tax brackets, absolutely. Also consider the retirement lifestyle you want. Do you want to have a lower income in retirement, or do you want a much higher one and continue to have that growth mindset?
Yep.
Especially with inflation. And then also remember there can be changes to the tax law and you might lose some benefits like the QBID that we discussed earlier.
As we have learned a lot that taxes can be changed and things can be different in the future. And so we want to plan now, but also be prepared for the future, but also know, again, who knows what's going to happen. Again, the tax code is bigger than the Bible. It wasn't always that way. There's always been added and changed over time.
Yeah. So if you have these 3 different buckets, those different tax treatments let you control more what your taxable income is going to be, no matter how Congress changes the tax code. If tax rates go up, you can pull more from tax-free accounts. If they go down, you can use your pre-tax money. If there's a high standard deduction, you can take that from your pre-tax money, all kinds of fun things like that. Having money in these different buckets also can help you manage things like required minimum distributions, have more flexibility with your Social Security benefits, your Medicare premiums, if those things exist at that point. And you can just better control your tax bracket by choosing which bucket you pull from each year. So having options gives you more control over the tax impact on your heirs. And we're going to talk more about this also in a future episode this month. So be sure to subscribe so you don't miss that.
I mean, I do want to say, I was just literally talking to a friend of mine just now about his dad, who is in the 70s and saying, oh, wait, I made a lot of money. I'm doing good. Now I need to start thinking about this whole RMD thing, taxes, and planning on that. And he's like, I did not realize all of these things. I did so good of work, and his son is going to inherit a blessing, maybe even a mess. And so thinking about this before you're 72 is really important. When you're 40, when you're 20, start thinking and building those foundations now.
And if you're like, no, I don't want to do that. That sounds too complicated and expensive, and I've got more important things to do. Stay tuned after the break.
Ready to take the next step towards securing your financial future? Whether you're planning for retirement, saving for your dream home, or you just want to make your money work harder for you, the team at Wealth Wisdom Financial are ready to assist you. And now, it's easier than ever to see how we might give you a boost on your financial journey.
Schedule a 15-minute discovery call with one of us today.
And let's discuss your questions and your financial goals together.
Don't wait any longer. Your financial freedom awaits. Schedule your discovery call at www.wealthwisdomfp.com/call.
Okay. Now, we know some of you are thinking, this sounds complicated, expensive. Don't I need a fancy accountant or a big budget to do this stuff? Well, isn't this going to eat up all my time that I need to be putting in my business to grow my revenue and keep things going? Actually, no. While having a good tax professional is important, many of these strategies are straightforward enough for any business owner to understand and to implement. So we want to clear up some confusion that's out there. When you're making $1 million of gross revenue, you can ignore some of those complex strategies you might hear from bigger businesses. For example, don't go chasing, things that are more of a worry of international tax structures, right? You probably don't need to worry about that. If you have some real estate, you might want to do some cost segregation and pay the expense for that, but the tax savings might not actually be worth it at your level. Complex trust structures are typically overkill at this level, and you don't need to stress about the corporate minimum tax. That's only for companies making over $1 billion or so, I think, somewhere around there. Definitely don't need to worry about that.
I mean, again, I see this a lot where people are trying to figure this out, and I'm like, dude, what you need to do is make money, and have a problem.
Well, yeah, okay, so make money, yes, but here's the bottom line: make money. But you also want to make money as you focus on the fundamentals of accounting first, right? Clean books, proper documentation, understanding basic deductions will get you much further than chasing all these complicated strategies meant for larger businesses.
Yeah.
These fundamentals are likely to make your business more profitable too, right? You're able to see what's actually making money, what's losing money, and trim the fat and build a lean business and have more revenue with the right products that actually make more profits because you've got clean books and proper documentation and you know the deductions that you can get.
I think that's the thing, is clean and understandable, right? For you, right? If you're trying to have all these little loopholes or things that oftentimes we're paying for the complexity and we're not really receiving the results. Whoever's selling us on the other tools that can save us, we realize, oh, we saved taxes, but then we paid a lot. I mean, think about it. Even then, paying a tax person to figure out how to avoid paying taxes, it's kind of an interesting thing.
And also a lot of these same things, clean books, proper documentation, this is also going to help your business be more sellable or investable over time, which might be worth way more than whatever tax savings that you're chasing after and trying to get. So remember, tax planning isn't just about paying taxes or paying less taxes. It's about understanding how to work within the system to grow your business efficiently. The strategies we talked about today aren't loopholes. They're intentional benefits that's put right there in the Internal Revenue Code to help businesses like yours succeed. So use them. And if you want to dig into this more, be sure to hit that subscribe button, because we've got some really awesome episodes planned this month about how to avoid getting on the wrong side of the Internal Revenue Service.
No one wants that.
Getting audited and having to pay $20,000 of back taxes and fines and penalties and everything. We're going to talk about planning for a sell of your business and how you can set up so that you don't end up paying a whole bunch of taxes when you sell your business, or your children don't end up paying taxes and they inherit your business, or you end up retiring and living off the business, still owning the business, but not running the day-to-day. We're going to talk about how you save taxes at that point and so much more. So hit the subscribe button and don't miss an episode. And we got one more goodie for you.
If you want to take action on what you've learned today, head over to Wealth Wisdom Financial Community for your free small business tax strategy checklist. Again, we said a lot there. So having this little checklist may help you. I mean, seriously, you got to run a business. There's so much more besides all that number stuff and tax stuff. You didn't get in to do all of that. You got in to sell the widget, right? So go download Small Business Tax Strategies Checklist at our community. It breaks down everything we covered in today's episode and simple, actionable steps that you can start implementing right away. Plus, it includes a bonus section on record-keeping templates that will make your life much easier when tax time rolls around. Because having simplicity and clarity, I know your tax guys will love that too.
Yeah, maybe save you some money too. Thanks for joining us. Again, hit that subscribe button, and we hope you live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.